If the market crashes 30% tomorrow, most investors are going to lose everything. They'll lose their sleep. They'll lose their sanity. And eventually, they'll lose their entire life savings. Because they're going to panic sell at the absolute bottom. But here's the crazy part that the gurus and the Wall Street suits are praying you never find out. Your portfolio value could drop by 6 figures. And you could still get paid exactly the same amount of cash as you did when the market was at an all-time high. I spend way too much time thinking about why we've been brainwashed into obsessing over a digital number on a screen, a number you can't actually spend at the gas station. Here's the question that defines your financial future. If your portfolio drops 30%, but your income stays exactly the same, are you actually losing money? Most people would say yes. I'm here to tell you they're dead wrong. In a 30% crash, you don't actually lose money unless you sell. But here's what nobody realizes. Most people don't lose money in a crash. They lose control. Also, quick side note, we're only 60 people here. Basically 60 future millionaires. So if you're not subscribed yet, you're early. Welcome to the inner circle. And this is where it gets dangerous. We've been lied to. The financial industry needs you to focus on the price because that's how they control you. If they keep you staring at the red and green candles, they can sell you protection, they can charge you management fees, and they can keep you in a state of constant anxiety. They want you to believe that the stock market is a casino where you're just a lucky gambler. But when you switch to an income-focused mindset, you aren't just an investor anymore. You're the house. And in this game, the house always wins. I'm slightly frustrated because I see smart, hardworking people being treated like sheep by the big banks. They want you to believe that volatility is the same thing as risk. It isn't. Volatility is just the price moving around. Risk is the permanent loss of capital. And here is the part nobody survives. By trying to avoid volatility, most people actually increase their risk of going broke. They trade a temporary dip for a permanent disaster. But here's the part that really hurts. During the 2008 financial crisis, the end of the world, according to the news, the S&P 500 crashed over 50%. It was a bloodbath of price. People were jumping out of windows figuratively and literally. But while the price fell 50%, the actual dividends paid out by those companies only dropped by about 20%. Think about that ratio. If you were focused on the income, you were literally twice as safe as the guy staring at his net worth. And if you owned the right companies, the dividend aristocrats, your income didn't drop at all. It actually went up. Imagine the psychological power of that. The world is burning. And companies like Johnson & Johnson or Procter & Gamble are sending you a notification saying, hey, we're actually giving you a raise this year. That is the cheat code to the stock market. If you want to stop fearing market crashes and actually start getting paid during them, hit that subscribe button right now. If you're tired of the guru hype and want a strategy built on math and reality, you're in the right place. Now you might be thinking, Nick, if the price drops 30%, surely that means the business is failing? This is exactly where people lose everything. They confuse the price of a stock with the value of the business. It's a total psychological trap. Think about it like this. If you own a small apartment building that brings in $5,000 a month in rent, and some crazy guy from the neighborhood knocks on your door every morning shouting that your building is worth 30% less than it was yesterday, do you care? Do you pack your bags and sell the building at a loss? No. You ignore the crazy neighbor and you go cash the $5,000 check. The stock market is just a very loud, very bipolar neighbor. Stop letting a crazy person manage your retirement. And this is where it gets really interesting. Let's dive into the history books, because total return investors hate talking about the 1970s. From 1968 to 1982, the stock market went effectively nowhere. For 14 years, the price was flat. But here's the brutal truth. Growth investors didn't just lose money. They got wiped out by inflation. For over a decade, they made zero progress while the cost of living doubled. It was a lost decade that destroyed millions of dreams. But the dividend investor? They were getting rich. While the prices stayed flat, the companies were still earning profits and paying them out. You were accumulating more shares with your dividends, and your actual income was compounding. By the time the bull market finally returned in the 80s, the dividend investors had massive portfolios, while the price seekers were just breaking even. This is the part nobody tells you. You don't need the market to go up to get rich. You just need the income to keep flowing. But here is what the total return crowd won't tell you. They'll say dividends are tax inefficient or forced sales. They love talking about spreadsheets in a vacuum. But they never account for the human element. They never account for the fact that in 2000 the Nasdaq fell 78%. Growth investors didn't just see a dip, they saw their entire future evaporate. Imagine watching your $1 million turn into $220,000. Do you think you'd have the diamond hands to hold on? Statistics say no. Most people sell when they've lost 20%. The industry wants you to be a robot, but you're a human. An income stream is the only thing that provides the psychological floor to keep you from making the one mistake that ruins people, selling at the bottom. When you get paid to wait, waiting isn't a chore, it's a job. Here's what most people don't realize about market crashes. They are actually the greatest wealth accelerators in human history. When the market crashes 30%, the world isn't ending. The world is having a clearance sale on the future. And this is exactly where people lose their nerve. They trade their future freedom for a temporary sense of relief. But if you're reinvesting dividends during a crash, you are buying more shares, which produce more dividends, which buy even more shares. It's a feedback loop that turns a market disaster into your personal goldmine. While your neighbor is crying over his 401k statement, you're looking at your dividend tracker saying, I just bought 30% more of Coca-Cola's future profits for the same price. This is the wealth illusion. Most people think they are losing money because the price went down, but if you own the same number of shares, you own the same percentage of the company. You still own the factories, the patents, and the brands. But here is the oh shit moment that most people never consider. If your portfolio pays you enough to live, a crash doesn't make you poor. It makes you dangerous. Think about that. If your bills are $4,000 a month and your dividends are $5,000 a month, you are officially untouchable. You don't need a job. You don't need the market to be green. You have decoupled your survival from the opinions of Wall Street. When everyone else is desperate and forced to sell their assets to survive, you are the one with the cash to buy them. You aren't a victim of the economy anymore. You are a predator in it. That is the ultimate level of financial power. Let's look at the wealth illusion with real numbers. Imagine you have $500,000 in a portfolio yielding 4%. That's $20,000 a year in cash. The market crashes 30%. Your screen says you have $350,000. You feel poorer. But if your $20,000 in dividends is still hitting your account, your lifestyle hasn't changed. You still eat the same food, drive the same car, and live in the same house. The only thing that changed was a digital number that you weren't going to spend today anyway. Who is actually richer? The guy with $1 million in growth stocks that pay zero and just dropped to $500,000, forcing him to sell shares to pay rent? Or you with your $20,000 shield? The truth is, the growth investor is a slave to the market. You are the master of it. I'm slightly frustrated because I see smart people getting played by the volatility narrative. The media needs you to be scared because scared gets clicks. Wall Street needs you to be active because active generates commissions. But the wealthiest people I know don't care about price action. They care about asset accumulation. They want to own the toll bridges of society. Look at companies like Realty Income. They own thousands of properties leased to 7-Eleven and Walgreens. When the stock market crashes, does 7-Eleven stop paying rent? No. People still need snacks and basic supplies. Does Walgreens stop selling medicine? No. The cash keeps flowing to the company. And the company keeps flowing the cash to you. And this is the part nobody survives. Those who think they can outsmart this simple logic usually end up broke. This is where it gets really interesting. Yield on cost. This is the ultimate wealth secret. Imagine you bought a stock 10 years ago for $50 that paid a $2 dividend. That's a 4% yield. Today, that company has been successful, and they've grown the dividend to $6. Now, the stock price has also gone up to $150. If you look at the stock today, it only yields 4%. But your personal yield on the money you actually invested is 12%. Even if the market crashes 30% tomorrow and the stock drops to $100, you are still getting $6. You are getting a double-digit return on a boring stock while the rest of the world is panicking. You are literally making more money from your dividends than most people make from their jobs. That is how you win. That is how you stay wealthy. Now let's talk about the enemy. The financial gurus on social media will tell you that dividend investing is for boomers. They'll tell you that you need to be in high-growth tech or swing trading options to get rich. They need you to be in the price game because that's where the dopamine is. It's gambling disguised as investing. But ask yourself, how many of those gurus are actually wealthy from their investments versus their courses? Real wealth, the kind that lasts for generations, is built on cash flow. Look at Warren Buffett. Most people think he's a value investor. No. He's an income investor. He buys companies like Coca-Cola or Apple not just because the price might go up, but because they send billions of dollars in dividends back to Berkshire Hathaway every year. He's building a fortress of cash flow that is immune to the market. And this is where it gets dangerous for the average person. If you follow the growth crowd, you are betting on the greater fool theory. You are hoping that someone else will pay more for your stock than you did. But in a crash, there are no fools left. Everyone is terrified. That is exactly when the growth strategy fails. But the income strategy thrives in the dark. In fact, some of the best dividend-paying companies in history were built during the toughest economic times. They provide things people need, not things people want. And as long as humanity needs food, energy, and medicine, those dividends will keep coming. So, here is the fortress plan you need to implement right now. First, change your dashboard. If the first thing you see when you open your app is total balance, you've already lost the mental game. You are letting the market dictate your mood. You need to be looking at projected annual income. If that number is moving up every month, you are successful. Period. It doesn't matter if the market is at an all-time high or an all-time low. If your income is growing, you are winning. Second, you need to build a swan fund. Sleep well at night. That's 6 to 12 months of cash. This isn't for returns. This is for your soul. It's the armor that allows your income machine to work without you interfering. When the market crashes and your neighbor is panicking, you'll look at your bank account and realize you don't have to sell a single share to survive. That is the ultimate power. Third, and this is the most important part, you need to stop listening to people who have a vested interest in your anxiety. If a guru is telling you to jump into the next hot AI stock but can't explain the cash flow, run. They aren't investing. They're gambling with your future. You need to focus on companies with low payout ratios, strong balance sheets, and a history of raising dividends for at least 10 to 25 years. These are the soldiers in your army. Their job is to march into the market and bring back more money for you every single quarter. The surprising revelation at the end of all of this? In a 30% crash, the rich don't get poorer. They just get more control. They buy the shares that the panicked masses are throwing away. They lock in 6% yields on companies that usually only yield 3%. They use the crash to create a level of generational wealth that most people can't even fathom. Most people think they lose money in a crash. But the truth is, they just lose their nerve. They trade their future freedom for a temporary sense of relief. Don't be that person. Look at the 2020 COVID crash. The market fell 34% in a single month. It was terrifying. But if you owned a diversified portfolio of consumer staples and utilities, your income was virtually untouched. In fact, many companies used that crisis as a way to prove their strength. They raised their dividends right in the middle of a global shutdown. If you had stayed the course, you wouldn't just be back to where you were, you would be significantly richer today because you would have reinvested at the bottom. At the end of the day, money is just a tool to buy back your time. Don't let the price of the tool prevent you from using it. You've worked too hard, sacrificed too much, and saved too diligently to let a line on a graph dictate your happiness or your future. Stop betting on price and start investing in income. Stop being a consumer of the market and start being an owner. An owner doesn't care about the ticker. An owner cares about the profit. This is the mindset shift that separates the 1% from the 99%. The 99% are trying to guess where the price is going. The 1% are knowing where the income is coming from. If you want to stop being a victim of the market and start being a victor, you have to change your philosophy today. You have to stop looking at your portfolio as a lottery ticket and start looking at it as a business. And a business that doesn't pay its owners isn't a business. It's a hobby. The next crash is coming. It's not a matter of if, but when. And when it hits, the world is going to be divided into two groups of people. The first group will be staring at their screens with tears in their eyes, watching their wealth evaporate, and wondering if they'll ever be able to retire. They will be the ones begging for a rebound, praying that the price comes back so they can feel safe again. The second group, your group, will be sitting back, watching the checks clear and looking for the next bargain to buy. They will be the ones getting a raise while everyone else is getting a pay cut. If you want to see the exact Dividend Fortress portfolio I'm building to survive the next crash, you need to watch this next video where I break down my top 5 forever stocks. These are the companies I'm betting my own retirement on, the ones I trust to keep paying me even if the world falls apart. Hit that subscribe button right now if you want to stop living in fear and start living in freedom. Don't let another market cycle pass you by while you're sitting on the sidelines or panicking with the crowd. Take control of your income, take control of your time, and take control of your life. The only question left is, are you going to panic? Or are you going to get paid? I'll see you in the next video.